Listen, we've been talking about this now for many years on the back of an unprecedented bull market run, and we've been consistently proven wrong. Clearly, the prices they're paying, the valuation are, I would define them full, driven really by the quantitative easing, the excess of liquidity in the system. So would I expect returns to probably suffer a bit? Maybe. But what's different now versus 5-10 years ago is that the private equity are taking a much more active approach in the management of their portfolio companies. So they're all aware of the fact that the music might stop sooner or later. They all had to live with COVID and the pandemic and factory closure and businesses halting for months, and they've reacted well. So I think they have the tools today to still manage these businesses. I think on the positive side, if depending on what Jay Powell will tell us later, if there is an element of tapering in the system, I think valuation will inevitably go down. I think it will not impact so much deal making, but the prices at which this asset will transact, that can be seen as beneficial.
That's interesting that you say that. I mean, that sounds premature given the guidance we're getting from a lot of analysts in the market who say this is tapering, this is not interest rates rising. It won't have any near-term effect on the cost of capital. But you see it differently.
I'm not an expert in that, but I see a relaxation of quantitative easing as something that could impact not so much the cost of capital, but the availability of capital in the system. And this inevitably will impact the amount of debt and the price of debt when you think about leverage, a leverage context.